There is a recurring pattern in economic history that repeats with almost mechanical precision. It doesn't happen every decade or at random, but only when very specific conditions align. These conditions include extreme asset valuations, record-breaking debt, excessive leverage, and a widespread belief that the current situation is somehow different. Finally, a trigger event occurs that forces liquidation. These conditions were present in 1929, again in 2008, and now in 2026, they are all present once more. This isn't speculation or fear-mongering, it's pattern recognition. History shows us how these crises unfold, who loses everything, who profits, and why the next crash could surpass even 1929 and 2008 in scale. The difference now is that leverage is higher, financial systems are deeply interconnected, and those in power have already used their tools dealing with previous crises, leaving little in reserve. January 2025 shows us the setup. Every financial crash begins with a bubble, and currently we are witnessing the largest everything bubble in history. Stocks, real estate, and other assets are overvalued simultaneously. The median home price in the US is $420,000, while median household income is $75,000. That gives a ratio of 5.6 to 1, whereas historically sustainable housing ratios are around 3 to 1. Housing is now overvalued by nearly 87% relative to incomes. In 2006, prior to the housing crash, this ratio peaked at just above 5. Corporate debt is at record highs, with non-financial corporate debt totaling $13.5 trillion, which is 72% of GDP. Back in 2007, it was only 43%. Government debt has reached $36 trillion, 120% of GDP. And interest payments alone are nearing $1 trillion annually. Consumer debt, including credit cards, auto loans, and student loans, exceeds $17 trillion. In total, the U.S. economy's debt exceeds $90 trillion, over 320% of GDP. Every sector is simultaneously leveraged beyond historical norms, creating a fragile system primed for collapse. For 15 years since 2009, the Federal Reserve has conditioned markets to believe that they will always intervene. Every time markets dipped, the Fed cut interest rates or printed money through quantitative easing programs such as QE1, QE2, QE3, and the COVID stimulus between 2008 and 2022. The Fed added more than $8 trillion to its balance sheet, pushing asset prices higher. Investors learned a simple rule: buy the dip because the Fed will save you. This created moral hazard. Risk was effectively removed, and no one feared losses. But now the Fed has limited ammunition. Interest rates were already near zero for a decade, and the balance sheet expanded to $9 trillion further expansion risks, reigniting inflation, which became a problem in 2021-2022. The Fed responded by raising rates from 0% to 5.5% in just 18 months, the fastest rate hike in 40 years. While this halted inflation, it also created a new crisis. Debt that was affordable at 3% is now crushing at 7%, from corporate bonds to mortgages. The Fed cannot lower rates significantly without risking inflation again. The economy is trapped with no easy solutions. Comparing 2025 to previous crashes, the patterns are identical. In 1929, the stock market rose 400% in 5 years, with margin debt reaching 10% of GDP. Everyone believed stocks would only go up. Economists even spoke of a permanently high plateau, suggesting crashes were impossible. Then, in October, the market collapsed 89% over 3 years. In 2008, housing doubled from 2000 to 2006, mortgage debt reached 100% of GDP, and subprime loans exposed banks to catastrophic losses. Belief in ever-rising prices turned fatal when defaults spread, triggering a 57% S&P decline. Both crises followed the same formula: bubble, leverage, belief in permanence, trigger, and liquidation. In 2025, the bubble is at historic highs. Leverage is enormous, and people believe Fed intervention makes crashes impossible. A trigger could be commercial real estate, corporate or sovereign debt defaults, or even a geopolitical shock, but the exact cause matters less than the underlying conditions. Once liquidation begins, the process is brutal and inevitable. Phase 1 begins with the trigger and an initial shock. Markets drop 10-15% in days. Investors may see this as an opportunity to buy, assuming the Fed will intervene. Media reassurances create temporary calm. But cracks in confidence appear. Phase 2 is a false recovery. Markets stabilize or rise slightly, convincing many that the worst is over. In both 1929 and 2008, these brief recoveries lulled investors into complacency before the real crash hit. Phase 3, the cascade, is the core of the collapse. Margin calls force leveraged investors to sell. Mutual funds, hedge funds, and pension funds face redemptions. Algorithmic trading amplifies losses. Liquidity disappears. Credit markets freeze. The feedback loop destroys wealth, slows consumption, and pushes unemployment dramatically higher. Phase 4 is maximum panic, the bottom, and when fear peaks and selling becomes indiscriminate. Finally, Phase 5 is a slow recovery, often years in duration, requiring massive government intervention stimulus and systemic reforms to restore confidence and rebuild economic stability. Every crash transfers wealth. Those unprepared lose everything, while those who understand the pattern position themselves to profit. Middle-class investors holding stocks and homes are typically hardest hit. History shows that massive wealth shifts occur during these cycles, rewarding foresight and punishing complacency. After the initial shock and false recovery, the real devastation begins. Phase 3, the cascade, starts when forced liquidations spread through every layer of the financial system. Leveraged investors face margin calls, and anyone who borrowed to buy stocks must sell when prices fall. Even a moderate 20% decline wipes out much of their equity, triggering immediate sales that push prices even lower. Mutual funds, hedge funds, and pension funds face redemptions as panicked investors demand their money back. These funds are forced to sell assets into a falling market, creating a snowball effect that accelerates the decline. Algorithmic trading compounds the problem. High-frequency trading algorithms detect downward momentum and automatically sell, while stop-loss orders trigger additional selling. Circuit breakers temporarily halt trading, but when markets reopen, panic resumes. Liquidity vanishes. In the worst moments, no buyers exist at reasonable prices, causing markets to gap down 10, 20, even 30% in a single session. This isn't just a decline, it's a collapse. Credit markets freeze as fear spreads. Banks stop lending because the risk of borrower default becomes too high. Companies that need to refinance existing debt cannot, resulting in more defaults. Banks with exposure to these failing companies incur massive losses, which in turn weakens their balance sheets and threatens further insolvency. The cycle feeds on itself, dragging the economy into recession. Stock market crashes destroy trillions of dollars in wealth. Consumers feel poorer and drastically cut spending. Businesses lose revenue and lay off workers. As unemployment rises, spending falls further, creating a vicious feedback loop that deepens the downturn. Historically, these cascades last months or even years. In 1929, the market fell 89% from late 1929 to mid-1932, and unemployment soared to 25%. Banks failed by the hundreds, and many citizens lost their life savings. In 2008, the cascade was shorter but still brutal. September 2008 to March 2009, with the S&P falling 57% and unemployment reaching 10%. Government intervention was massive, but still required years for the economy to stabilize fully. In 2026-2027, the cascade could span 12 to 18 months, potentially wiping out 50-70% of equity market value. Unemployment could spike to double digits, and bank failures may be widespread. During these phases, panic spreads psychologically as well as financially. Investors who survived the initial shock may cling to hope, believing that central banks or governments will rescue the system. But when interventions appear insufficient or delayed, fear dominates decisions. The media amplifies anxiety, focusing on collapsing institutions, bankruptcies, and the stock market's sharp declines. Headlines become warnings that force ordinary investors to sell at the worst possible time. Confidence is fragile, and once lost, it takes years to rebuild. The types of losses are predictable. The middle class, often holding most of their wealth in stocks and property, suffers the most. Real estate owners who leveraged heavily at historically low interest rates struggle when rates rise sharply. Mortgages issued at 3% now cost 7%, making many households unable to meet payments. Homeowners may default, and banks foreclose. Meanwhile, those who borrowed to invest in equities face margin calls that destroy savings and retirement accounts. Corporations with high leverage may fail, causing employees to lose jobs, pensions, and benefits. Every previous crisis has shown that those unprepared and overexposed to debt bear the brunt of the collapse. Conversely, those who anticipate the pattern can profit. Historically, investors who shift capital into safe assets, cash, gold, or undervalued opportunities, during early phases often acquire massive wealth at distressed prices. Short-selling stocks or bonds can yield enormous returns as prices fall. Hedge funds and institutional investors positioned to benefit from declines emerge financially stronger. The lesson is clear. Understanding the mechanics of bubbles, leverage, and triggers allows some to survive and even thrive while the rest are devastated. Commercial real estate remains one of the most likely triggers for the cascade. Many office buildings are permanently vacant due to remote work trends that will not reverse. Mortgages that once worked at low interest rates are now unsustainable at higher rates. Defaults are rational from a purely economic perspective and could affect hundreds of billions of dollars. Regional banks, which hold a significant portion of commercial mortgages, may face insolvency if defaults mount. Bank failures alone could spark panic selling and accelerate the collapse. Corporate and sovereign debt represents another risk. Companies that borrowed heavily at low rates must now refinance at much higher costs. Failure to do so could trigger defaults that cascade through bond markets. Sovereign defaults, particularly from emerging markets with large dollar-denominated debts, would create a global credit crisis. When these countries fail to pay, banks in developed economies take losses, further destabilizing the system. A single default could set off a chain reaction, showing how interconnected today's financial markets are compared to previous crises. Finally, a geopolitical shock could ignite panic even if financial fundamentals appear stable. War, natural disasters, pandemics, or political crises can force rapid liquidation of assets as uncertainty spikes. March 2020 demonstrated this when a health crisis triggered a sudden market collapse. Any event of similar magnitude could trigger the 2026 cascade, regardless of valuations or debt. Ultimately, the underlying fragility ensures that once a trigger occurs, the mechanics of collapse, forced selling, margin calls, liquidity loss, and credit freezes take over quickly and ruthlessly. As the cascade continues, fear spreads beyond financial markets and begins affecting the real economy. Businesses facing reduced demand cut costs aggressively. Layoffs accelerate, not only in finance and real estate, but across industries from manufacturing to services. Supply chains are disrupted as companies postpone orders or default on contracts. Consumer confidence collapses. People stop spending on big-ticket items, from cars to appliances, and even reduce everyday expenses. This amplifies revenue declines for businesses, leading to further layoffs. Unemployment spikes, creating a vicious feedback loop. In past crises, this feedback loop extended the recession, turning market crashes into broader economic depressions. In 2026, similar dynamics could occur on a global scale. Households feel the impact immediately. Mortgage defaults rise. Renters may see eviction waves if landlords fail to meet mortgage obligations. The middle class, particularly those heavily invested in stocks and real estate, experiences severe wealth destruction. Retirement accounts and savings accounts shrink as equities lose 50 to 70% of their value. Unlike previous generations, today's population also carries unprecedented student loan and credit card debt, which compounds financial stress when income falls or employment is lost. Banks and financial institutions face extreme pressure. As defaults rise, losses mount on loan books. Banks' capital erodes, forcing regulators to intervene. Historical patterns show that bank failures during crises trigger panic. Depositors fear losing their savings and withdraw funds, creating liquidity crises. In 1929, bank runs led to hundreds of closures. In 2008, Lehman Brothers' collapse and the subsequent credit freeze demonstrated how interlinked institutions amplify panic. In 2026, with higher debt and global interconnectedness, a similar event could trigger a more rapid and widespread banking crisis. Central banks will likely step in, providing emergency liquidity and cutting rates, but the scale of the collapse may exceed their capacity to stabilize markets immediately. Corporate debt defaults will amplify the panic. Companies that issued bonds at historically low rates now face refinancing costs that exceed their earnings. Large corporations, even Fortune 500 companies, could fail. Each default shakes investor confidence, driving yields higher across the corporate debt spectrum. Contagion spreads quickly. Bondholders sell other holdings to reduce exposure, forcing more companies into distress. Supply chains are affected when critical suppliers default, causing ripple effects that impact production and employment. Historically, corporate defaults in a crisis accelerate the downward spiral and prolong recovery. Sovereign debt risks add a global dimension. Emerging markets with large dollar-denominated obligations, such as Turkey, Argentina, and Pakistan, could default if capital inflows stop. Investor panic spreads, currencies collapse, and cross-border credit exposure forces banks in developed countries to absorb losses. The cascade becomes global, affecting not only domestic markets, but international trade, foreign investment, and currency stability. This interconnectedness means that even economies with solid fundamentals can feel the shockwaves, demonstrating how a single default or geopolitical crisis can trigger a worldwide financial meltdown. Government interventions will eventually occur, but they face constraints. Debt levels are already extreme, and stimulus packages risk further inflation or fiscal instability. The Federal Reserve and global central banks may cut rates to near zero, provide emergency liquidity, and purchase distressed assets. Governments may implement multi-trillion-dollar fiscal stimulus, attempting to stabilize employment and consumption. However, the effectiveness of these interventions may be limited due to high debt burdens, leaving the recovery slower and more painful than in previous crises. Social unrest may rise as citizens experience prolonged unemployment and wealth destruction. Policymakers will confront difficult trade-offs between austerity, inflation, and economic growth. During the panic, opportunities emerge for those who recognize the pattern. Historically, investors with liquidity and foresight profit from distressed assets. Buying undervalued equities, government bonds, or real estate at the bottom generates massive wealth over time. short sellers can capitalize on rapid declines, while hedge funds, structured to benefit from volatility, thrive. The 2026 crisis will likely repeat this historical wealth transfer from the unprepared to those who anticipate and act strategically. Understanding triggers, leverage, and market mechanics is essential to navigating the collapse and preserving capital. The recovery phase begins only after maximum panic has passed. Government interventions, central bank liquidity, and fiscal stimulus help stabilize markets. In 1929, it took 25 years for the stock market to reach pre-crash levels. In 2008, stocks recovered within 4 to 6 years, aided by aggressive policy responses. In 2026, recovery may take even longer due to higher debt, global interdependence, and complex financial instruments. Full economic stabilization may not occur until 2032 or later, and some sectors may remain depressed for a decade or more. Throughout the cycle, the key lesson is predictable. Excessive leverage, overvalued assets, and misplaced confidence create crises. Triggers vary: commercial real estate, corporate defaults, sovereign debt, or geopolitical shocks. But the mechanics of panic, liquidation, and contagion are consistent. History teaches that those who recognize the pattern survive and often prosper, while the unprepared suffer devastating losses. The 2026 crisis is not hypothetical. The conditions mirror 1929 and 2008, making awareness and preparation crucial. Timing and strategy determine whether individuals and institutions endure, recover, or gain from what will be one of the most significant financial events in modern history.